Well, joining us now is Tim Evans from Longleaf Trading Group. He joins us live now from the CME in Chicago. Tim, hello to you. Thank you for being with us. Certainly, we are seeing that U.S. oil focus really back in play once again, but it is a move back to the bear camp. Just give us your take on some of that news flow and some of that trading action that we have seen.
Sure. First off, happy belated Easter to you, Natalie, and your viewers. Yeah, I mean, clearly coming in this week, to start the week, the bear camp seems to have kind of gained some control. The news flow over the last couple of weeks, clearly has been very favorable for bulls in the energy space. I mean, you've had a combination of, geopolitical concerns. You've had, U.S. dollar favorability. So it's been a market environment that's been conducive for, higher prices. I think, as we settled out last week, the Baker Hughes rig count data kind of puts everything back into perspective in terms of, having the market begin to, or not begin, but continue to look at the supply aspect of the market and realize, U.S. shale has outperformed most estimates, in terms of the role that would play in the effectiveness of the OPEC deal. So I think the market's kind of re-examining that here to start this week, and that's given the bears something to work with to start.
One of the items certainly that we are watching closely alongside that initial price action is oil volatility, and we have seen that slipping, the index hitting a 6-week low as crude prices rebound. We have a chart up on screen at the moment, Tim, that I'll walk you through. The white line viewers are seeing at the moment is the crude oil volatility index. The blue line is that WTI price, and we're certainly seeing them heading in different directions. Why are we seeing that move downwards in volatility, to your mind, Tim?
Well, commodities as a whole tend to have a positive skew with respect to volatility. So, when you have a market that's moving up in price, if it's a hard commodity, typically volatility will rise during that up movement. But if you get a day like today where the market sets back, volatility tends to fall. The fundamental reason for that is, markets can move infinitely higher, but they can only go to zero. So when markets really begin to move higher, the question is, well, how high can we go? So you'll see hedgers willing to pay a larger premium for option positions or hedge positions. So, that's a relationship you'll typically find in most commodity markets with respect to volatility.
So if we consider what we're watching then, looking ahead to the oil market, we are seeing the IEA saying that global oil market is very close to reaching a balance. But what do we need to see in terms of from OPEC producers and also from that weekly rig count in order to ensure that?
Well, the one thing I can, definitely feel confident speculating on is as long as these prices maintain these levels or higher, that rig count data is going to continue to reflect more rigs week over week. U.S. shale, has been very active and been pretty successful, given the circumstances. There's a lot of news reports of, a lot of investment capital continuing to flow to the shale regions in Texas. So again, higher prices will continue to support that activity. With respect to OPEC, I think a couple of things really need to line up to kind of offset that bearish force that's coming from U.S. shale. We're going to need to see demand numbers that meet projections or better. And if you look at the international demand figures, we are seeing record levels of demand out of China, but demand in other parts of the world is we're not seeing a whole lot of that. So we're going to need to continue to see record levels in China. We're going to need to see demand, I think, improve in other parts of the world. Obviously, OPEC members and non-OPEC members that are part of this deal are going to need to continue to comply, and they're clearly going to need to get this thing extended past that June date.
I just wanted to switch focus slightly, Tim, and discuss gold. Despite obviously this huge upward momentum that we have seen in gold of late as that safe haven tool amidst that geopolitical concern, where we are seeing geopolitics take somewhat of a backseat, particularly in the US as we have earnings coming to the fore, we have as such seen gold paring back some of its gains, moving off of that 5-month high. Nonetheless, and in fact, we have a chart up on screen at the moment showing the relationship we have between gold and bond yields at the moment. The white line, just for viewers, is the US 10-year bond yields, the blue line being gold spot prices. Do you still see the precious metal as being in a bull market, however?
Yeah, I mean, we touched down right under that $1,300 level basis June futures. In that area, not only being a psychological resistance level, but, there's some chart resistance there as well. So I think the setback today is, some profit taking for those that, have been a part of this, pretty dynamic move here over the last couple of weeks. But yeah, I mean, gold very similar to crude oil as we just discussed. I mean, the news flow over the last couple of weeks has been very favorable. We had Donald Trump's statements last week, commenting on the dollar being, at too high relative to its international currency counterparts. So I think the market's beginning to question whether the concept or the policy of the U.S., which is strong dollar policy, which was established in 1995, is that under review, or are we looking at a different approach to U.S. Currency here moving forward as part of the Trump administration? But ultimately, I think to get through that $1,300 level that served as resistance, I think we're probably going to need to see some development, in fear with respect to the French elections. Maybe the further escalation of the North Korean conflict, or I think a move lower of 100 par in the U.S. dollar index obviously would be helpful as well.
You touched there, Tim, on the similarities between the gold and the oil market. I also just wanted to ask you about the role that China plays within gold also. We saw particularly that higher than expected growth number last week. What role does this play within the gold market?
Yeah, I mean, and I think we're actually seeing a lot of the market reaction to better than expected Chinese growth numbers. I mean, we're really seeing that a lot in silver. Silver is more of an industrial metal, so I think the market's beginning to speculate that we could see an improved level of demand in the silver space. I mean, silver's trading at the highest level since November. The spec side of the market, is at 116,000 contracts, which is a record spec position the market's ever held. So I think gold ultimately is following silver some here as the silver market seems to be reacting a little stronger to that Chinese growth figure that you just referenced.
So in terms of the drivers in the few weeks ahead, what do gold traders watch?
Well, I mean, the French election on April 24th, I think is going to be in key focus. Obviously the market's very concerned with, another populist uprising and Miss Le Pen, who, depending on the day and which poll you're looking at, seems to be doing relatively well. Last poll I saw, she was polling at 23%, moderate candidate at 23%. So most likely Miss Le Pen will make it to the second round, which is slated for May 7th. So if that in fact occurs, I think the anxiety over the potential of Ms. Le Pen winning the election, it definitely will translate into at least stable, probably more favorable gold prices.
Tim Evans, we will leave it there. Thank you very much.
Thanks, Natalie.